Welcome everyone to this Angel Investing for Beginners session. I'm thrilled to have you here. Thank you for joining on this lovely Tuesday morning. We have three great speakers and panelists here for you today. We will try and keep this very engaging of a conversation and engage all of you into it as much as we can, roping you in to ask your questions or add comments. This room is pretty diverse across the board as I'm seeing names. Some are new to me and others are very familiar. I encourage all of you to chat about yourself, whether you're an entrepreneur or an investor or just an interested party in the chat, and then a link to your business, to your LinkedIn, however you would want people to connect with you after the fact. I'd like to recognize that I am zooming in from Anchorage, the lands of the Dena'ina people who have stewarded these lands for, gosh, thousands of years, and thanking them for that stewardship, past, present, and future. I'm Melanie Lucas-Conwell. I manage the 49 State Angel Fund, which is a venture capital fund and public-private partnership program hosted within the municipality of Anchorage. So zooming in from City Hall itself, we have a program where we match private capital investments into startups across Alaska to double their money if we can. There are a couple of different check size ranges. So we've been working for, gosh, the last 9 years at this fund to disperse funds into promising Alaska startups and helping grow the ecosystem with events such as Alaska Startup Week, which I hope you all know about at this point, since it seems like we've plastered about it everywhere we could. Alaska Startup Week has over 60 events happening this week that we are so excited about, ranging from educational sessions to open houses featuring entrepreneurs and discussions between founders. So I hope that you have all added some of those events to your schedules and calendars to make sure that you make the most of all these free events happening. And with that, I'll let our panelists introduce themselves. Adie, do you want to kick us off?
Sure can. Hi, I'm Adie Akufo, one of the heads of venture programming over at Wefunder. Wefunder is a regulation crowdfunding platform that's helped raise over $362 million to date for founders from both their community as well as accredited investors. Most people also know me as AAA, so we can go with that as well. I'm currently calling or zooming in from the Austin, Texas area on the central lands of the Tongulong, and thank you all. Super excited to be here.
Thank you, Adie. Anna, how about you?
Good morning, everyone. My name is Anna. I am a business owner here in Alaska. We started a fossil fuel donuts company a few years ago. We do keto, vegan, paleo donuts. And in starting this business, I also had the opportunity to start investing in Alaska companies. And that's how I got involved with the Alaska Angel Conference as a co-fund manager last year. And now working to get our next edition for 2022 set up. Super happy to be here and to help however I can.
Thank you, Anna. Ricky.
Hello, everyone. My name is Ricky Tejapaibul. I'm the managing partner of Tech Wildcatters. We're a venture capital fund and startup accelerator program. We were founded in 2009. We are headquartered in Dallas, Texas, but I'm here this week in Anchorage, the land of Dena'ina. I'd like to acknowledge the founders of this land as well. But I'll be here all week. So if anyone after this call wants to grab coffee, meet in person, then happy to set up some time. But yeah, I'd like to share our knowledge of what we work with the startups to help startups say what channels of funding are available for the startups and what investors are looking for as you go through each stage of the cycle of your startups.
Thank you, Ricky. I'm so thrilled to have all three of these panelists. As you have questions, please raise your Zoom hand and we will gladly help unmute you and ask those questions live. ask them in the chat. Let's make this an engaging session as much as possible. That's why we didn't make it a Zoom webinar, but rather a Zoom meeting so that we could see all of you and make this much more personal, since investments tend to be that way. So to kick us off, could each of you tell us a little bit more about the stage of companies that you invest in and the types of investors that you try to attract within your funds? And for Ricky specifically, perhaps you could give us a little bit of insights as to what a VC fund, what your investors are into the fund itself.
Yes.
So whoever wants to unmute first, please go ahead.
Yes, I can go first since I already hit the unmute button. So we're a venture capital fund, and the way we do is we have investors that invest in our fund, and then we as fund managers then invest in startups. So we're similar to your shoes, that we have to pitch to our investors that why is investing in a startup something that they should be doing, and why are we the experts, the qualified people to help you find those investments. So investors in startups could be anywhere from angel investors, and angels could do direct investments, or they could invest in the fund, could be family offices, could be corporates that want exposure to startups, could be pension funds, could be fund of funds, sovereign funds. So if they look at it from a portfolio standpoint, that venture capital is an asset class that has a very long horizon, because when you invest in a startup company, from investment to exit, it could be anywhere from 5 years or even longer cycle. But then the returns that they're expecting is also higher, and it's illiquid, meaning that if they invest today, they can't just decide a month later, I want to sell my investment. So it comes with this illiquidity, that they're in it for the long haul. But we're trying to educate them that, hey, if you invest in just one company, it may sound like it's risky, but if you invest in a portfolio of companies, then the risk level actually goes down. And a lot of times it's not as correlated with how the market moves, because the stock market goes up and down every day, every week with some external news. But when you're investing in startups, you get to find a good company with excellent founders, and you're in it for a long haul, so you're less prone to those short-term market movements.
Thank you, Ricky.
Sure,
Adie.
I thought we were working backwards. All right. So for Wefunder, we kind of work with founders looking to raise a community round. So usually it's individuals who are either looking to start their pre-seed round, friends and family. Basically, if you're able to if you're looking at raising a portion of it, already have soft commitments from friends and family, most likely coming onto our platform, a 2x to 3x the investment volume going towards your company, right? So it's usually for individuals who've already spoken with angels, already spoken with their family members, looking to raise a significant small round. And then from there, coming onto our platform, allowing our user base of around 1.3 billion users to also co-invest alongside them. We work with individuals from funds like 49 SAF, all the way to also micro VCs and angel syndicates who are just looking to supplement their current rounds that they're investing in for companies. And one of the biggest benefits to this is that these individuals already have the knowledge associated with investing and the track record, so that individuals who are actually unaccredited investors can kind of invest alongside them, knowing that they have a track record of raises or successful exits for the companies that they've invested in.
Hi, everybody. So for the Angel Conference, we invest in Alaska companies. In the previous editions, we invested in Alaska companies. Some of them had already revenue, so we can do like a revenue redemption model or notes. And some of them were in the customer developing the product. They had an MVP and doing the customer discovery. So we go for the very beginning of the company to having some revenue and some history, but not a high income yet that VCs would be interested.
Thank you. So as you all can see, these three investors are very much across the spectrum in terms of at what point in time do they play in with a startup's growth and the stages that it's going through and when you need that money. following up with that, how do you each recruit startups and let them know that you are open and ready for business and writing checks?
I guess I'll go first. So multiple channels. So let's say this week we're out here in Alaska. We want to talk to Alaskan entrepreneurs because there's a lot of startups out there. There's a lot of VC funds out there, but we really believe in that it's a match of relationships, that we invest in you because we trust you, or you take money from us as an investor because you trust us. It's not just that every dollar is the same, but how do we not only provide capital, but provide value? And it has to be a founder that we're comfortable working with in the longer term. So this is an example, but we also have applications on our website. We get a lot of inbound traffic as well that'll come in, they'll apply to our accelerator program. And we also go to whether it be tech events, conferences. We were just out in Web Summit in Lisbon last week. So we got to source founders from around the globe. So we're headquartered in Texas, but only about a quarter of our companies are from that region. We get companies from East Coast, West Coast, international, and hopefully find some Alaskan companies here as well.
I second Ricky there. It's a relationship match. So there's a lot of coffee drinking. You got to talk to a lot of people and develop your network, and that relationship will last a long time. So it's, again, being out there face to face with people and asking, who should I meet, and who else do I need to talk to, and showing what you can bring to the table and what you're looking for.
Again, I think it's multiple different avenues like Ricky and Anna were just talking about. Most of the time for Wefunder, it's mostly inbound coming in. So inbound usually takes up around 40% of our actual, like the companies that are coming through our platform. The other 60% comes in from different events we're kind of co-hosting, all the way to different accelerator programs we are partnering up with, to working with portfolio managers of different firms who are looking to to basically allow their, if it's a CPG product, allow their consumers to invest alongside them. And then from their angels and syndicates, as well as micro VCs. And currently we're also running a few different programs when it comes to like venture partner programs with different institutes, as well as based upon the geography as well. So we're looking to expand our venture programming arm, not only in the US, but actually in Latin America, Europe, and Africa the next couple of months as well. So a lot of deal flow, hopefully.
And the 49 State Angel Fund is very happy to be one of those venture partners for Wefunder. And as Adie mentioned earlier, 49 SAF has invested through Wefunder into local companies, one of them being Baby Vend, led by Jasmine Smith. So we've been thrilled to have that partnership. And one of the things that always strikes me as it comes to deal flow is that you always think you know who you want to be targeting, and you have that list of emails, but you keep going back to all of them. And probably some of you are on my target list already when I send out information. But it's really about capturing the ones that you don't know how to reach, or who it is that is not in your network, but should be a company that you're investing in. And that's really hard to do. So a lot of engagement, and entrepreneurs are busy founding their startup and getting it off the ground, and not necessarily spraying and praying all of the investors to see who's going to respond and write a check to them too. So it's a very fine balance between all of that. And we have a great question already from Oki. Thank you for asking it. How are investors navigating evaluation of projects or products that will ultimately be owned by a community rather than traditional capital shareholder models? And thinking about, okay, so as investors, or at least, okay, you're welcome to unmute and give more clarification, but also, I think I would be interested in hearing from the three of you around, well, how do VCs or angel investments play if it isn't a traditional capital model? Oki, did you have more details to give?
Yeah, so I guess the reason this question's coming is In the space that I hang out, there's already the ability to kind of collect a form of capital from users. But what we're realizing is we're needing to almost create tools immediately that aren't necessarily part of like a final end product, but they build onto a product roadmap. And those key elements could use funding. It's where, like, you need to find talent real quick to build something or have certain specialties on the team. And maybe like the timeline is in 3 years, the product will be done, but along the way, we have to have these key pieces made. For now, what we're doing is basically trying to build tools that integrate into existing platforms like Discord or other tools out there that have an API, but we're integrating some of the functionality of Web3, like JSON web tokens. So, and the IPFS network stuff for NFTs. But that's why I'm wondering, like, do any funders just look at specifically like investing in little areas for a project? Do they have to see a whole roadmap? I'll pause there. Thank you.
Sure. Okay, so in terms of Wefunder, and especially when it's looking to raise from your community, right? That one is specifically targeting as your company as a whole, right? So it's mostly individuals investing in the product in itself and saying, hey, look, in the next couple of years, it's either through a safe note or convertible note. Mostly in this case for you, I would definitely go with a safe note. It's saying in a few years, we see this project coming to life in this aspect. This is the possible valuation it may be coming in at that point in time. And so unlocking your community and saying, hey, look, you guys can invest in this right now when it's still on the ground. And this is possibly where we're going to be going is fantastic, because we don't need the full map here. Most individuals who are investing at this point in time are looking at seeing what kind of product can you build out right now and how will you get there, but we don't need to see the full product roadmap at this point in time. Sorry, I need some water. But yeah, that's pretty much it at this point in time. It's mostly wanting to see exactly what is your plan right now to get to the certain stage you're looking at, and then from there, of course, on a different round or a secondary round, that's where we want to see exactly your 5-year plan at the end of the day.
Yeah. When you say owned by a community is a collective of individuals, correct? So it still be owned by shareholders, but it could be hundreds of shareholders, thousands of shareholders. And then there's certain, so startups typically try to stay with just accredited investors or a small investor pool, because once you go above number of investors, then you're subject to more of a public offering, SEC regulation. But at some point, once you do cross the threshold, then yes, the company can get funded by the community, and investors in the early stage will also acknowledge that at some point the company will go through that public offering. But at the end of the day, we're building a great product, but investors are also looking for return. So it's a product that will make the company sustainable, profitable, and also create good things out there for the economy, for the community. And with that, then it'll also attract investment dollars from the community. And it could be dollars that they're writing checks to the company, or it could be as customers, as participants, or as growing the community. So I think it goes hand in hand. It also increases the value of the company when there is such a strong user base that's also invested in the company, maybe not really like as a shareholder, but has incentives aligned to see the company succeed.
Piggybacking off what Ricky was saying, in terms of how things are done, especially with crowdfunding platforms currently, is that we utilize an SPV associated with anyone's investment. So every single person that's possibly investing into your community or investing year round currently will be placed into one line on the cap table, very similar to what Angel Syndicate utilize. And basically, you just have to elect one lead investor to oversee the entire round. So the best part about this is if there's ever an opportunity, let's say for you guys to acquire a different company, you only need to reach out to that one lead investor versus trying to unlock the entire community to sign off on something, right? So that's fantastic moving forward. And I just wanted to chime in there.
That's really cool on that last one. Thank you.
Gosh, those are all better answers than I could have given. Thank you, guys. And hopefully that brings a little bit more clarity there, Oki. And taking even a step back, generally speaking to the three of you, what do you look for in a startup and in an investment? And what does that diligence process look like? Partly from an investor standpoint in the room, some of us are investors here, to share those nuggets of wisdom, but then for the startups here, what should they make sure that they're including in their investment proposals, in their pitches, and maybe even what does not work and people should not spend any time on?
For me, one of the first things I look at a company is the team. The individuals working, how their relationship with more than one owner, their relationship, and how I can relate to them. If there is, if we speak the same language, if the values are aligned, and beyond the team is for me is the customer discovery. Have they doing their market research? Have they found out who their target is? As the company develops, you have a target market more narrow and narrow, so you can tell the age of the customer, the gender, where they live, and all of that. In the beginning, that's very hard to do because it's an expensive process, but having the basis covered for that is for me the first and most important.
Yes. For me, I think it's about the founders. It's about building that relationship, that trust, and seeing your progress. Sometimes it takes updating investors, build a relationship 6 months to a year, even before you're ready to raise the funding round, saying this is what we're planning to do, and then show that you're actually making progress towards that, whether you hit all the milestones that you said you were going to, or even not, but what did you do throughout the process? What was your learning experience? And how is it that you're showing your resiliency and keeping investors in the loop on that? And that's something that's very important.
Definitely. And for us, it's a little bit different, right? So it's usually individuals who are targeting their network very early on. And so for us, it's mostly for an outside investor that's looking to jump in to a round that's already open. It would be the team, how looking at their backgrounds and seeing how they're able to adapt, right? Having those conversations if possible and seeing, okay, what was your previous role in a different organization? Are you a subject matter expert in this particular organization, that particular industry you're jumping into? And then lastly, of course, specifically for Wefunder, it's unlocking your network. Do you have a strong enough network that's looking to back you either from testimonials or either to investing directly into your product? That's what we're usually looking for, especially when they're launching on our platform, because it's all a network and marketing game at the end of the day. It's making sure that you're able to, one, sell your story in the right way to actually convince a lot of our investors to say, yes, we want to take a chance on you. And that's the biggest thing, just making sure that you're able to convince them and they're able to actually look at your background and say, yeah, you are the person to make this happen. And that's one of our, I'd say one of the biggest things we look for.
And looking at the flip side, what startups have you seen do something that you thought might actually hurt their pitch and their investment capabilities? I feel like we all have a story of, oh gosh, this person did this one thing and they really shouldn't have. What has that looked like without naming any names?
I think it's about being truthful to your investors, being truthful to your audience, that this is where you're at now. This is why we see the opportunity. But investors, because investors sees hundreds or thousands of pitches all the time. And if you're making stuff up, you're claiming things that you can't really back it up, then they'll see through it. And then once you lose credibility on one thing, then the rest of your pitch then pretty much goes down the drain, because then what else can I trust? So I think that's something that's important. Show that you're genuine and you're differentiating, and you're not just trying to copy what another company's doing or something, but show that why are you unique? Why are you the best in the world in what you do? And we don't have the entire full resources for everything, but what areas that we need help with. And if you can identify those things, it goes a long way that you self-evaluate that what can I keep doing to continue to improve.
I would have to agree there. I would definitely say is, I think something we've seen in the past is about traction associated with some companies, and then kind of falsifying that traction. And usually when we are able to look at their current revenue, have their financials done in GAAP format, that's where we start seeing a little bit of issues associated with the numbers that they've plugged in. There was one company that during the first initial phases of their raise, utilized financials done by them internally. We looked over them. They seemed to be decent. However, a couple weeks later, when we sent it over to one of our CPAs, they ended up looking into it and being like, no, this is absolutely falsified. We definitely have to go ahead and cancel this campaign right away. And luckily enough, we hadn't dispersed any funds during that time because the Form C hadn't been filed. And so it was a great catch by us. But looking at those kind of things is something that Wefunder and other Reg CF platforms are getting better at in terms of making sure that we keep everyone accountable when it comes to finding these actions.
I think for us was some situation similar to what Adie just said, mixing funds from personal and business in the beginning. So the credit card bills are all combined, the accounts are combined, so you can't tell what's business, what's home mortgage. And it was really hard to tell where the business was financially, because it was person and business. I know when you're starting your business, you're doing everything, but your personal life finances and your business finances have to be separated.
Thank you all. And let's see, we have a question from Brad Pizzamenti. If Brad, do you want to unmute and ask it around traction and capital?
Yeah, sure. So I'm trying to get clear about, precisely what the relationship you all see as between investment in a company and furthering where that company's at, obviously, when we're talking about pre-revenue startups. I've always been told that money is more of an accelerant than a resource itself. Throwing money at a company won't get you traction. It will just speed up the processes that team is executing on. And I guess I'm curious, what other resources you look for to make sure that that money is accelerating the right things? Thanks.
So I think it's about proving each part of your business cycle, each part of your business model, and each investor, they'll have the different investment thesis, invest at different stages. So let's say a Series A investor want to see certain things, and then they're looking to scale at let's say you prove it in one market, or now let's go after 10 other markets. If it's a seed investor, then you've proved some level that, or you have an MVP, you're still building your product, but you've also proven that at least it de-risks a lot of the things from early on. So it really depends on traction you're looking for. If it's an accelerator, like so for us, we have the accelerator, we also have the later stage. But let's say for accelerator, we wouldn't say that any business model, oh, you're too early, come back with us with some numbers, but it's about how do we help you get to those revenue numbers that a seed investor would then find attractive. And the rule of thumb would be, let's say $1 million in annual recurring revenue, ARR, or even you're not $1 million yet, but you have the strong pipeline that you're growing at this much month over month, that you will get to that $1 million within a year. And that's something that you can start teeing up, and our seed investors will see you as, all right, you're having meaningful revenue numbers with traction. And so revenue paying customers, that's the best traction. But in some business models, then it may not be paying customers, but if you have 100,000 users, you have 1 million users, then they may not pay you directly, but maybe it's a two-sided marketplace that another customer on the B2B side might be paying because they want access to your users. So by showing some of these meaningful numbers, I think that goes a long way.
It's interesting. I think I was thinking of the question kind of the other way around. In other words, the notion of VC as partner to help create the traction rather than using traction as a qualifier for their involvement to begin with.
Yes. So traction from a customer standpoint is one thing, but the VC may be looking at, and that's if it's a VC that's an earlier stage that we're willing to come in at pre-revenue or certain revenue numbers, but we still want to see from a product standpoint or from a business competitive advantage standpoint that what are you building and how we can help you build that. But you have to have something that you've shown progress. So let's say if you're very early at napkin idea, then for the accelerator portion, yes, you may be a good fit for that. It will still take you longer though to get to that seed round, or to show outside investors that want to see more traction. But there will be investors or angels that are willing to work with you even early on because they believe in your vision. They believe in your background, what you differentiate, what's your competitive advantage. Even you haven't actually built it yet, but they can only help you so much. They can only invest a small amount of capital. They can only contribute to so much. And then we have to show that traction in order to attract some of the larger later stage investors.
And to add on to that, expanding the question a little bit more, investors are there to see these companies grow. Early stage angel investors, family and friends are all there to support you. And it's not just about the money. Of course, money is very important, as we all know, but it does, those connections, that mentorship, and oftentimes if you don't have both a technical and a business background in your company, advisors can help plug in those gaps in knowledge and help direct you. At the later stages of the company, it can be very much about connecting you with potential customers and other business partners that would help you grow, or even recruit and hire folks for your company. All of that, well, to some extent, the investors want their returns, so whatever will make their investment more valuable and increase their returns is really at the end of it, but really to see you be successful. We've also gotten some questions. Oh, go ahead, Adie.
Oh, sure. So for us, it's mostly some of the companies that usually come on, especially if it's a napkin-based idea. We've had a few different napkin ideas where it's a digital wallet coming on. And the founder only knows about crypto. However, they weren't a technical founder, but they were able to raise $750,000 due to the fact that, one, they had a large network, because again, they were a YouTube star talking about crypto. They were able to bring their YouTube following over to the investment side and actually invest into the products. And then from there, they ended up hiring a team as they kept on developing, as they were continuously raising. They kept on recruiting team members, and then at that point in time, providing updates to their investors that actually help them raise more funding. For pre-seed, we usually look at traction, LOIs, your current team, and your advisors. And then for a seed stage, is mostly a level of pre-seed was, but also looking at like kind of the prestigious points. What acceleration have you gotten into? At the same time, have you raised capital from a significant VC or a micro VC? And then from there, their network as well. So it's like looking at any kind of PR that you've done previously, making sure that we're able to tap back into any PR articles or anything that is like showcase your company before, in order to kind of build up the momentum when you do launch once again.
That's awesome. Great. We got a couple more questions around what is a lead investor? What is the difference between a lead and a follow-on investor? What are the risks perhaps associated with both of those roles? And how to think about it both from a founder perspective, but also from a potential investor perspective too.
So a lead investor is usually an investor that puts together the term sheet. So let's say if you're doing one funding round, so you're raising $500,000, $1 million from multiple investors, usually the terms would be the same terms. It wouldn't be, oh, you're negotiating separately with 10 different people. But the terms has to be pretty industry standard, as in, or let's say it's a convertible note or safe note. What's the valuation cap? What's the discount? And what are they, any rights, investor rights, board observer, board seats. But other than that, a legal document may have 5 pages, 10 pages, but usually it's pretty standard. So you wouldn't try to go and negotiate certain things that are pretty boilerplate. So having a lead that understands the process then makes the process go a lot more smooth. And then other investors who may be less experienced, or their model, they might be investing in a bunch of deals, but they don't want to be leading deals, then they'll be following on. And usually the lead is also going to be the point of contact. So that with that, and then they may be connecting with other investors, or sometimes if there's a board seat or board observer seat, then the lead usually will be the person that represents those investor group as taking a board seat. The lead typically takes a larger position in the round, but it doesn't have to be that, oh, they're the largest. Sometimes there's investors that may have a larger check size, they may have a large position, but they say they don't want to lead the round because of the administrative work, or they're positing that we don't want to take a board seat. But another investors might be a slightly smaller check, might be taking that board or board observer seat, or want to be more hands-on.
Tag along and answer Liam's question here. He was asking about stay plugged in the deal flow. Tag along with the lead. I wouldn't say lead the deal yet, but tag along with the lead investor, ask all the questions, plug in on all the meetings, and learn their process and see the questions they ask and all the documents in request.
So in regards to Wefunder, in terms of a lead doesn't have to be the individual that's investing the most. However, they have to be investing a minimum of $1,000. Most of the time, individuals who are usually leading this are either principals at micro VCs or angels, or someone that you really trust. So, because again, the lead is going to be there for long term, going to be advising you on a daily, not a daily basis, hopefully, maybe on a quarterly basis or monthly basis. You want to make sure that they agree upon your vision associated with the company. And so most of the time with Wefunder, it's usually not the person writing the largest check, but just a minimum of $1,000, because you want that person to basically think of the company first, and then from there make sure that they're not trying to position your company in a way that you don't want it to, right? So making sure that you guys both have the same vision in mind when you're asking them to be in that position, because at the end of the day, they also receive the pro rata rights associated with the round. And so even if they're investing a minimum of $1,000, and if they're your lead and you raise 300,000, they have the pro rata rights associated with the 300,000. So they can go ahead and spin out an SPV on your next round to keep that position associated with your rights, even though they only invested 1,000. So you want to make sure that this person is somebody you will see long-term associated with your current company, and at the end of the day, it's going to be able to advise you follow in any capacity following your Wefunder round.
Thank you. And hopefully that clarified some of the questions around lead investors and what their role is in all of this. And for 49SF, for example, we are follow-on investments only. So we won't lead the rounds. The staff is myself, and I have Matthew Robinson, who's also on this call, helping me out. We're a very lean staff, but we certainly want to be making as many deals as possible. We just don't have the staff and resources to negotiate the deals first and foremost. There was also another question from an investor perspective from Jake, saying the news seems to be indicating that capital is flowing like never before, which is very true. My question is this: how can you be competitive as an investor and still get the returns you need when you're competing with entities that seem to prioritize massive quantity over quality?
I could jump in on this on our end, right? So one of the biggest things we're currently establishing for next quarter is sidecar funds associated with some of the major companies, right? So major investment firms. Most investment firms are able to go ahead and throw larger amounts of money, and that's something that they're able to do just due to the fact that they've had a lot of exits previously. And so the fact that they're putting these large check sizes, they usually have something called a sidecar fund, where individuals who are from either family offices or just accredited investors are able to invest alongside them. We want to do that for unaccredited investors. And so now we're working with VC firms as well as angel syndicates and saying, hey, look, you can have a unaccredited or Reg CF unaccredited version of a sidecar fund where you're allowing the community who has been following your deal flow for years and years and years to basically invest alongside you. So any single time you throw in a check, basically they can follow on in terms of unaccredited individuals putting in $100, but the organization can go ahead and lead that round and have the pro rata rights associated with their community portion, the sidecar fund. So this is just a way for unaccredited investors to invest in the same deals that these large organizations are actually taking up, but actually benefit based upon the fact that they don't have to do the hard work associated with getting those companies to the next level, right? So you're basically utilizing the larger VC firms to do all the hard work whilst you benefit on the back end by just relax. Hopefully.
Yes, for us, it's about quality over quantity. So we want to find the right founders, the right company, and also at a reasonable valuation as well. So if we're competing deal with other different VC firms, we're not going to win because we're giving you the highest valuation, we're giving you the most money. But if we're going to win, it's because we can convince the founders that we're going to be adding most value, that we're the best partners for you in the long-term standpoint. So we will give term sheets that's competitive, but we're not going to overbid just because that's the market conditions. And for the founders as well, that you want to look at that is it the most important that you get the strongest term sheet or the strongest partnership, somebody who has your back as an investor, that your incentives are aligned as investor with the founders in a longer term perspective.
I think one thing that is important for us at the Alaska Angel Conference is a beneficial agreement for both the investors and the companies. So giving it back to the Alaska economy and also making the terms acceptable for the investors. It's a relationship that has to be mutually beneficial. We want make a deal that will disincentivize the founders to work on their company. So we need we always look to give those terms that will keep the founders engaged and have the ownership on their company.
Thank you. And there are, well, I think a lot of us have watched Shark Tank on TV, and oftentimes we think about those investors that are so, gosh, cutthroat and asking for outsized portions of the company to some extent. But that's not the case for every investor. And oftentimes you're thinking, well, I really need that money, so I'll take any terms. But there is certainly a big piece of startup founders need to be also cognizant of what they're getting themselves into and have that proper understanding. And if that's a place that you're currently in, there is a legal basics event happening tomorrow by attorneys from Dorsey and Whitney as part of Startup Week. So I'd encourage you to attend that and ask all those questions for free from those attorneys. Let's see, we had a question around what metrics do you look for as investors to help either with the long-term growth of the company? Is it customer lifetime value that you're specifically looking for? What should this group of startups be thinking about in terms of quantitative measures?
So I think there's multiple measures out there. There's revenue, but it's also what's the quality of the revenue, what's the margins, what's the customer acquisition cost? Are you paying to acquire revenue that's going to be value added for your company in the long term, or are you doing it to grow your user base, which some companies do, that early on the economies of scale may not be there, but you have to be able to prove that at some point it's going to be a sustainable, profitable business. And you have to show the milestones that because let's say a seed investor will look at what an A investor will look at, how can we help this company get to the Series A? The A investor will look, how do we get the company to the Series B? So they'll look at all these metrics, and then the growth metrics, is it going to grow fast enough to be a venture-backed business, then will be attracted to VC funds, or is it a small business, which is fine too? The investor may just be a different type of investor. It might be a more stable business, or they may have certain assets that's going to back those businesses. So when we look at funding, it doesn't only have to be the high growth, ultra high growth venture capital. It's finding the right investors that meet with the type of business and the metrics that your business is able to deliver. But they'll look at comparables, look at peers. All right, let's say if you're opening a coffee shop, what do coffee shops look at for metrics, like what's the cost, what's revenue per customer, how often are repeat customers, the traffic. So there's each industry will have those different metrics, but they will compare with the industry. Or if you're opening up a new segment of the market, then they'll look at, all right, so how is this differentiated from what was before? And it could be something that's really attractive, but you have to convince them with the numbers that this is where you're at now, and at a steady state where you project it to be 1 year, 2 years, 3 years from now, it's going to be something that's going to be very attractive.
Thank you. And I'll also answer Oki's question in the chat about additional metrics and portfolio investments that are much more impact inclined. There's a movement and a commitment about due diligence 2.0 that I've been keeping an eye on that looks at triple bottom line metrics and analytics from an investor standpoint, and I'll add the link in the chat, but that's been something that's been interesting to see. How do you incorporate ESG metrics into your investments, both as a startup and as a funder? And ESG standing for environmental, social, and governance metrics. Let's see, I think there was a question from Magpie, which I'm not sure if that's your first name or your business's name, about investors investing in companies that are much more community spaces, so theaters, cafes, events, production spaces, and they're dialing in from Valdez, Alaska. I think the answer is yes. Ricky answered that a little bit of, well, there are all types of investors out there, and they might all be looking for different deal types and types of returns too. And it's just making that matchmaking between the investor and the founder to make sure that it is mutually beneficial in the long run, and that we stay away from Shark Tank type investments.
Yes. And a little add to that as well, that even if you're doing a location-based business, sometimes you start with the first location, and if you find a model that's scalable, then it could also replicate to other cities, other locations as well. But you have to start with the first one and decide what part of the business cycle you want to be, whether you want to own the property or you want to manage the property, or you're creating a software that's going to help manage the property, because some other parts of it could be a very scalable business on top of something that's very traditional.
Did you want to add anything, Magpie, around this?
No, it's just good to hear that, because in this startup week so far, I've just heard a lot of tech conversation, and I'm kind of the only one involved in the arts and community-based event stuff. So, but yeah, I have heard that scalable comment. So thank you for adding to that. So you're right. We do need a few platforms designed.
Thank you. And I would say there are a lot of open houses by more traditional businesses that are happening this week too. I know Kodiak is live streaming from the Kodiak Brewing and Still facilities, which will be really neat. There are some CPG companies, consumer packaged good companies. There in Anchorage, there's Blue Market, Alaska, that is going to do an open house as well. So there are a lot of cool things. I know we tend to be very tech focused because that's where the big bucks can often come from, but there are some great, more brick and mortar type businesses that are absolutely worth investing in. There was a question from Andre about federal grants applications and how do you treat matching funds? And I'll take a first stab of answering that. In the case of 49 State Angel Fund, we will match we can't match public grants. So if you had a private grant from a foundation or other entity, we could match it. However, we do look to the founder to present us with a term sheet. and do the research around legally and accounting wise, what are the implications of having both grants and equity investments in your company. How do the three of our panelists view grants as part of your investment process?
So I think grants can also help in the earlier stages because grant is non-dilutive funding. So it's better than raising capital that you either have to pay back if it's a convertible note or a loan, or if it's equity, then they'll own a part of the company. So there are grants, a lot of programs out there, and if even for us, we're looking into it as well, that if it's something that's going to help jumpstart you at the early stages, and if it's a good fit, then by all means go for it. It usually requires some specialization because the grant is usually pretty industry project or type specific. There's some that's a little more generalized, like SBIR, something that's for more from R&D type, and then it usually goes in phases, and once you show certain milestones, you can continue on those phases. But there's also a lot of local type grants that I'm not too familiar about, but there is a lot of them out there, and you want to see that if it's pretty low hanging fruit that you can get. Usually the dollar amount is not huge, but if it's something that from a smaller company, then it still helps that you want to be diligent with your capital if it's something that can help you early on. And sometimes it also builds credibility. It's not only the dollar amount, but it builds credibility that, hey, we got this grant, we got vetted by these agencies, and with that, then it may open more doors to customers or other funding later down the road.
Yeah, I'm just going to second everything Ricky just said.
Terrific, thank you. Brad.
Hey there, I'm curious if you all can touch on notions of ownership, at least where it touches VC. We're in the process of structuring our bylaws around a steward ownership model, and that is going to likely preclude any kind of traditional exit. And I just wonder if that also takes traditional VC off the table. Thanks.
Who wants to tackle that?
And I'll take a stab at it. So depends on the bylaws, we have to read it. Usually, so a business attorney that is familiar with startups usually set up a company in a certain way that's most attractive, as in it's standard, and whether an angel investor or a VC will look at it, and that's the structure that's going to be able to grow with the company. The management team may change. The founders may have tighter control at the beginning, but it's a governance structure. As the company grows, then it's governed by a board of directors, good governance, and as new investors come in, they may be able to nominate somebody on the board and help with the governance at that standpoint. And at some point, then either the company gets acquired or becomes public, and the board and the shareholders will have a role on that. Now, if you write it in a certain way where an exit may be prohibitive, then as an investor, you look at it. So if we don't exit to get returns there, then it'll be returns from dividends, from shareholders, the type benefits, which is possible, but then you have to look at from an economic standpoint, is it something that will give returns that's attractive? And for most investors, they may not have the flexibility to do that because there's other deals out there that they're also comparing with. So the more restrictions you put in there, then you have to compensate with either much more favorable terms. So instead of they want 5% of the company, it's like, I want 25% of the company because I need more control because I won't be able to sell, or there's certain things that will compensate. So at the end of the day, you have to decide, is it worth it from having that level of extra restrictions there, or is there other ways of governance that you can still have good governance and investor wouldn't feel too restrictive, while you can still get to push your vision, get to push your mandate to a much later stage with the right team of directors, right governance team that's going to help you push it to that. And it's not only about the type of control, but it's about, can you bring in vision? Because you can't grow a company alone. How do you bring in the right people that share that vision and try to bring it as far as you can?
Thank you.
Great. What great questions coming from everyone. With 3 minutes left in this event, and I know that there's, gosh, another funding related event that is about to start as part of Alaska Startup Week. There's another one around growing entrepreneurship during the pandemic, and a LinkedIn marketing event that are happening in 3 minutes. So there's a jam-packed schedule. I don't know which one you'll all select to go to, but I want to give a big round of applause, virtual applause, for our panelists for answering all the great questions, and for all of you who asked those questions and attended and took the time out of your day to participate here, because gosh, this was a great conversation. Adie, Anna, and Ricky, if you would kindly add any follow-up links or contact information in the chat for folks to reach out to you, however you'd like to be contacted, that would be lovely. Gordon, you read my mind. And I'll drop in a link if you enjoyed this session. We have, or actually hated it, we have a feedback survey to tell us how we did. That I would love for all of you to fill out and give us that feedback so that we can keep having great events as part of Startup Week. And there will be a giveaway for one random submission as part of that feedback form. So I encourage all of you to do it, at least for fun, to see what you might be able to win, and to make sure that we keep having some great programs. And with that, thank you all for attending today. I am copying and pasting and putting links in the chat if you want to hang on and take them down. And feel free to reach out to me as well at any point in time if I can be of any help. Thank you all, and happy Startup Week.